All right. So I see a few people out here. Where are you guys from? Are you from US? Outside of US? Um, Close to here? Actually, I'm in San Juan, Puerto Rico. Florida. Lived there a long time. Miami, Sebring, different places. Durham, North Carolina. Cool. Dallas. Awesome. Anyone else? Fernandina Beach. That's in Jacksonville, right? Around Jacksonville? Up there? I was in the Navy in Jacksonville. Oh, Massachusetts. Northeast of Jax. Yep, yep. Cool. Massachusetts. Oh, nice. Southern California. Nice. I lived there a year. Pasadena, or East Pasadena, or yeah, close to that. Cool. All right, guys. Let's get started here. Today, I'm going to be talking about the 5 core strategies that I use pretty much on a daily basis in my trading, and I have a special bonus for you guys in the end. So I want to make sure that you guys stick out there, and stick in there, and then so that you get a hold of that bonus. All right. So let's get started here. All right, so today I'm going to show you how to make consistent returns monthly based on margin capital at risk using high probability trades, okay? And these are without taking large losses to make those returns, all right? So what are we gonna learn here? How to manage zero DTE trades, how to manage SPX or SPX 7 DTE trades, how to manage SPX monthly DTE trades, so those are 3 trades, okay? How to manage options on futures trades, and how to manage micro futures, right? So all of those will have detailed entry, exit, stop loss criteria that you can bank on for your trade plan. All right. Okay. So again, stick with me till the end. We're going to have that bonus. And for now, I am guessing, right? I'm thinking that you are here for a reason, right? And I think I have 3 reasons why you might be here. So first is you're interested in learning new strategies that'll take your trading performance to the next level. Number 2 is you've seen, heard about, read about others making money trading, and you know that you can do it too, but you're just not seeing your account grow. And number 3, you've tried different trading strategies that you thought, okay, this is it, only to discover that it's just not getting you to the place where you want to be. Right? So out of those 3, which ones do you think are more close to you? Right? Number 1, interested in learning new strategies. Number 2, desire to see your account grow month after month. And number 3, find the right strategy. So let me know. Yeah, great. Hands. 3, Don, 2, Tony, 3, yep, perfect. That was me for a long time. All right, cool. Okay, guys, so let's move on here. So I am a regular guy. Those are my kids on the left-hand side, my parents on the right-hand side. That was an MBA program I was in a long time ago. And as part of that, I wanted to share with you our state of mind. Okay, so let's talk about state of mind and how you look at trading. Okay, so let's talk about imagining how it would feel like if most of your trades were winners month after month, and it would be confirmed by watching the size of your account grow at the same time. All right. Number 2 is becoming the trader that no longer takes large losses but consistently trades according to a proven trade plan that is profitable over time, allowing you to grow your account. those are really, really important when you go into trading, and it's really important to understand, that trading is a process that takes time to master, okay? And just like anything else, it requires experience, okay? All right, so hopefully after today, you'll have a better understanding of what you can do in terms of trading, okay? All right, so for now, let's look at the SPX credit spread, okay? So this is most of the trades that I use, and I'm going to share with you what these are. So some people may not know what they are, but credit spread is a combination of two puts or two calls where the put or call that is sold is more expensive than the put or call that is bought. Okay, so that gives you a credit when you put on that trade. So in this example here, the 40-50 and 40-40 put, you're gaining $50, and you multiply it by one contract by 100, right? So that's $50, and the selling of the 40-50 and put and buying of the 40 put gives you that credit. Okay, so the 40-50 is will allow you to basically to get that credit, okay, into your account. All right, the trade is considered a high probability trade, and the reason for that is because you just have to be within that range, in the market to experience a profit. Okay. All right, so let's look at the SPX options decay, and this is a chart of a call option going from 68 days to 0. Okay, so in the first from 68 days to 33 days, the rate of decay is 34%. From 33 days to 5 days, the rate of decay is 57%, and the rate of decay is 100% in a 5-day period. Okay, so measuring that with volatility, it's out there, but typically that's how the decay works in an option, and it's a great tool to use, because when you sell options, basically they're diminishing over time, okay, and then that gives you a better chance for a profit. So there are 3 profitability factors, okay. Number 1 is implied volatility. So the ideal setup in the market is for volatility to be higher before your trade and then lower after the trade. Okay, it doesn't always work that way, but it works really well, for like 0 DTE, and we'll talk about that. Okay, so implied volatility is something that you can't really see, but it's there. Okay, all right. So profitability number 2 is theta, which is one of the Greeks that measures the rate of decline in the value of the option. Okay, so depending on where volatility is, the market, the rate of decay can be slow or it can be much faster. Okay, high volatility into low volatility gives you that speed, that velocity. Okay, so profitability number 3 is market direction, and this is mostly useful for micro futures. All right, so in a position that you have, so if you put on a put spread, you want the market to go up. If you want to put on a call spread, you want the market to go down. Okay, so direction plays a great deal of movement during those times where the market is trending. Okay, where you don't want the market to trend is where you get that, those positions, and as long as you're within that range, you're golden. Okay, all right. Okay, so now let's go into 0 DTE, and this trade, I basically use this trade every single day. Okay, and I'm going to give you some examples for how to trade this, right, in different ways. Okay, all right. So first thing we got to understand is the pattern day trader rule. Okay, if you if you have an account that's over $25,000, you're fine, okay? But if you have an account and you're trading SPX options, then you have to be careful if you're trading those, if you have a if you have a the amount of money that you have under $25,000, okay? All right, so what is it? A pattern day trader is the buying and selling and selling and buying and selling and buying the same security on the same day, and initiates day trades 3 or more times in any 5 consecutive day period. And so you can do a day trade with SPX, and you can do it again, right? But if you go past three sessions, 3 day trades, before a 5-day 5-day business period, then you can get flagged, and you don't want to get flagged, all right, with that, because you can basically, if that happens, you may be restricted to only selling current holdings, okay? So they may restrict you to that. All right, so how do you avoid the flag, PDT? Well, you limit trades to 1 trade every three days per week. In other words, Monday, Wednesday, and Friday type of thing, okay? You manage trades from multiple accounts. That works. Trade iron condors, that are wider, that will allow you to have less exposure to the market. You can have a cash account, but you can't sell options on, or you can't sell verticals on a cash account. Or you can trade ES futures, which are not susceptible to PDT. Okay, we'll talk more about that when we go into the ES futures side. Okay, so let's look at the entry-exit guidelines for 0DTE. First thing is I trade, when I go into the market, I trade between 1 minute to 10 minutes of the market opening, and I use a 10 wide spread, and I'll share why I use that. Okay, the delta of that, one of the Greeks, okay, is that I use for the short strike is 7 to 8 on the short strike, and a premium of 50 to 75 cents. Okay, so that's basically what I do when I trade these. All right. Okay, so the way that you take profit is you can take $10 or less, right? Taking profit, and if you want to take 5 cents, right? It'll take about a couple more hours, to get there, right? In a 0DTE trade. Now you can let it go expire, you can let it expire as well, right? But each time you put on this trade, the longer that trade is in, the more risk you have. Okay, so keep that in mind. So another way to close the trade is expiration, and you never want to let a profitable trade turn into a non-profitable trade. Okay, but remember, you can let trades go into expiration, and there's no PDT restrictions on that. But if you do take that trade off, it's basically one day trade that you're susceptible to. Okay. All right. So the adjustments I do for these, based on my trade plan, is that I roll a bull spread, okay, and I close a bear spread. And the reason for that is because you can adjust a bull spread pretty easily, okay? Because usually the market is going down when you're in that scenario, and so when the market typically goes down, there's more volatility, and when you're able to roll and you get a chance to roll that trade, it's just more manageable. On the bear side, on the bear spread, it's much more difficult, to manage those trades. Okay, so let's look at an example of how these trades and how far they are from the market when you put these on. So the green ones are call options, and the red ones are or put options, okay? And so you can see here there's a lot more distance to the market typically, and this is with a VIX 22, right? And it's about a 1% and 1.2% compared to 0.9%, okay? So when you go to the width of 10, right, instead of 5, you can see here that it really pushes it out much further away from the market. And then when you go to 15, you know it goes higher. However, the amount of change as you widen your spreads diminishes. Okay, so you have a diminishing return as you go wider and wider on these spreads. All right. Okay, and then looking at the VIX at 27, you can see here how much bigger the market is away from the market. And so when you go to the next day, actually, if you look at it, look at this on the next day, it's actually less than what it is for 0 DTE, and that's pretty amazing, right? Just because the volatility at that point in time is really, really strong. Okay, right. So let's go into examples of trading 0 DTE now. What I typically do is I put on that trade and I just let it go. Okay, and then when we get to those inflection points, right, when you have to roll a trade or you have to cut it loose, that's the point that you wanna move on, right? So those are very typical things, or a typical way of trading 0 DTE. However, there are different ones that you can use. All right, so let's go through that. So here, in this case here, I'm using a 10 wide, and I open the trade at 45 cents. Excuse me. And then I opened a put spread at 45 cents as well. So right at the beginning of the session, okay? And you can see here where the market went. It went down and it went up, okay? So it's easy to look at it now, right? Because all you have to do is put these trades on and you would have been fine, all right? The market, would have expired those trades and that's it. However, when you're here, right, and the market's going down, that's a different story. So here, in that case, since I had a nice, decent profit here, I took the profit, okay, on this trade, and and you can see here that where the market dropped and went up, and that's basically a reversal. But in this case here, I just took the profit and moved on. Okay, so it was a very small profit, and just decided to do that. Okay. All right, so now let's open another trade, and here it's 50 cents. And the market went down here. So instead of, closing that trade, I actually allowed that to go down, and so I got 95 cents for that trade. Okay, and then later on in the day, the market went up, so I closed the put at 15 cents. Okay, so this was mostly a directional trade that it was going against us, but it managed, the market had managed to go up, and right before 11:30, basically we closed it at 15 cents. Okay, very typical that this can happen. All right, now you've got a trade here that the market is moving up. So now you put on this trade, you put on the put spread for 45 cents, and then basically we put on a call spread for 45 cents. All right, and so you can see here where the market is going. So after it started moving higher, I decided to call that. I decided to close that call spread, and you can see that the 39.50, 39.60, would have been okay, right? So it could have gone all the way up here, and you can see it's 39.55, right? it's kind of scary when it gets that high, all right? But it went down, and again, it could have expired. But there are many times that the market will continue to go up, and then you'll be in trouble. Okay, you'll have to manage that trade, and then in the next session, I'll share with you how to manage those kinds of threatened trades as well. All right, so here we close the trade at 10, and we moved on here. All right, so the risk here was at the upside, where it could have continued to go up, and sometimes it does. Right, and it's a good idea to just close the trade and move on. All right, so here now we have a call spread at 45 premium and a put spread at 50. And here, the market went down, closed that trade at 10 cents, and later on the market closed that trade at another 10 cents. So again, if you look at where the market was the whole time, right? You would have been fine in allowing this to expire. And so that's why I'm telling you that normally now, right, I let it pretty much expire. And then if the trade is threatened, we use the tools to manage those positions. And it works out. It works out pretty fine. But however, if you're risk averse, you can close those trades, and if you have enough capital to manage those over $25,000, you can easily manage those that way as well. Okay, all right. Here's another one, 45 cents. Again, put it on as a put, and then as the market went down again, right? With the same strikes, basically, we had a 45 and 50, and then closed the trade for 15 cents. All right, so here's another example, and this is an example where you widen spreads. Okay, so there is a way to manage these trades when the market is really strong and going against you. Okay, and widening spreads is a tool to use, right? But you need to have quite a bit of margin in order to manage those, right? Okay, so this was between 4 days, and it was a 0 DTE trade that we started it with. Okay, so here's the 39.50, 39.35, and at that time I was trading 15 wide spreads. And so that was 60 cents that we got on that, and then we put on the call spread that was 50 cents. All right. So here now the market went down, and basically, let me see what we did here. No, I put on another put spread here. Okay, and then the market started going down. So we closed the call spread at 15 cents. But the market continued going down, and at this point here, we rolled that trade from 39.50, 39.35 to 39.45 to 39.20, right? So we widened that spread, and it gave us a 75-cent credit on that. Okay. Then here we had to roll that trade again, the put spread. So we rolled that trade again, and we got a debit of 5 cents on that trade. And then as the market went down and then moved up higher, basically we closed that position for 30 cents. So now, if you see it here, so the first position here, right, that we rolled it from 15 wide. And then basically it was a 3,000 margin on that position. Okay, then we went to a 25 wide position, and again these are two positions. You can see here that the margin went from 2,500 down over to 5,000. Okay, because we are widening those spreads. Okay, and then finally we did a 40 wide spread, and the margin went to $8,000. But you can see here we collected, between debits and credits, $2.60. Okay, and then in the end, basically we closed the trade for 30 cents, and so we closed it for $2.30, and that's really what the trade gave us throughout that process. Okay, it's just another way to trade these. Okay, and but you need a lot more margin in order to go through that. All right, so so here is another example. Okay, so we go through and we got the call spread, and these are 10 wides now, right? So we got a 60 and a 60 for a call and a put, and here we rolled that trade for 40 cents because it was threatened, and then the next day basically we were able to close these positions and expired worthless. Okay, all right. Here's one here, 55.60, put and a call, and we rolled the trade again because the market went down, but you can see here that it went down and then it went right back up. All right, and so what happened here? We can walk through this. Okay, so let's walk through this. So we got a put at 60 cents, and then we had to roll that trade. We got a 30-cent credit for that. And then we put on a new trade, right, for that position, and this was 4100, 4085 at 90 cents. We rolled that trade, and we collected 15 cents on it, and then we had a new position here again for $1.05 for that put, and then we rolled that position for a 25-cent credit, and at the end of the day, basically, we got the new position for $1.30, and overall, we closed that position at 10 cents, and the total credit was $1.20. Okay, so that's how that kind of works, in these adjustments. It takes a little bit of time, but it's worth it in the end. All right. All right, so this is the performance for 0DTE since November 23rd, November at 2023. I moved from Thinkorswim to Tasty Trade, and we're working on the performance now for these trades. But you can see here that basically overall, these are really, these are trades that are really working based on that trade plan, and it works really well. Okay. All right. So let's talk about 7DTE now. A little bit different. With 7DTE, do the same thing. I like to enter the trade at the beginning and use that implied volatility. So I use a delta of 7 to 9 delta here in this case, or 12 to 14 delta for the put side, and 7 to 9 delta for the call side. Okay, so depending on the volatility in the target, basically we use 80 to $1.20 for the put spread, and then a little bit lower for the a little bit lower for the call side. Okay. Take profit, again, 10 cents for each spread, expiration, and you don't want that trade to be unprofitable, okay, at the end. Bull spreads, we do 5 to 10 before that trade is threatened. So between 5 to 10 points from a breach, basically we roll that trade, okay. And that's how we close it. On the stop loss for the bear spread, we do basically 2 to 3 rolls, and then we just move on this one. We just take the loss. Okay. All right. Okay. So let's keep moving here. All right. So this was This was a 70 TE trades that we did from 9:15:23 to 10:10:23. Okay, and these are actual trades that we put on. The market went from 18 SPX trading days and 282 points down, right? The market. So that was 6.6% change, and that can really, really hurt, right? If you're not managing these things correctly and with credit spreads. Okay, so I'm going to walk you through these 70 TE trades that we went through. So as we go along, so we collected $1.40, right? 70 cents and 70 cents for these trades. So during that period of time, the market went down, and we closed the call spread for 10 cents, and then we put on a new put spread here after we closed it, and then now we have a premium still of $1.30. Okay, and so here we rolled the trade, the put spread, because the market was going down, and then we basically put on a call spread, a new position, and so now we have a rolled position. You can see the -1 here, and we have a 30-cent credit there, and we have a 75-cent credit based on the closing of that other position. So we have a new trade there. So now our premium is $1.65. Here again, the position, the market continue to go down, and so we closed the call spread at 10 cents, and then we rolled the trade, the put spread, for 35 cents, and then we put on a new put spread for 65 cents. And so now our premium is $1.90. So here we rolled the trade again. And so we put on a debit spread this time, 5 cents. And then we put on a new trade for $1.10. And we put on a new put spread for 60 cents. And so now our premium is $2.95. So now we went back and we closed this trade for 15 cents, and we put on a put spread for 60 cents, a new put spread. And I'll be able to answer all your questions here, guys. All right. Okay. And now we have 2.8 cents on that, $2.80 on that credit. So now we put on we rolled this position, the call spread, and we got it for $1.10. And then we put on the put spread, and we put on this was rolled, okay, so it's $1.60 here that we put on, okay. And so now we have a premium of 3.9. Okay. So now we are at, we closed trade 628 for 25 cents. And then we rolled this position here. And we collected a debit of 15 cents. So that brought our premium down a little bit. Okay, so we have these trades on now here. Okay, so here we closed the position again for 20 cents. We rolled the put position again, and we collected 40 cents. And now we have a trade that's with 95 cents credit and $1 credit for the new trade. Okay, now we're at 3.7. And so here we closed that trade for 30 cents, opened a actually, and we, let's see, no, we rolled that trade and we got a 25-cent debit on it, and then we put on the put spread again for 70 cents, and now we have $3.15. We're almost gone. We're almost there yet, guys. Okay, so we rolled this time. We rolled this trade again, and this is the 6th time we rolled it. And you can see the position's getting wider and wider, right? So here we collected. We had a debit of 5 cents, and then we basically put on this put spread again for 65 cents when it was widened. So now we're back down to 3.1. At the end of the day, on October 10th, the trade expired, worthless. Okay, and that was it, basically, for that trade. So rolling that trade over and over again allowed us to gain in additional premium, even though we'd use some debits, right? Just for protection there, right? Because you can't always get a credit on it. And you want to be close, farther away from the market. But it works out in the end, all right? Okay, so let's go through then now the monthly trade for SPX. Quick question here. When you closed the previous trade, what was the iron condor? Oh, okay. When you go back, you can just take a look at those trades that we went through, and you can see the actual quantity in those things. Okay. Okay, good question on the well, wouldn't you put under and you close the call spread? You can't close the call spread. You want it once the trade is threatened. You'll need to close the threatened trade, or the trade that's profitable, so that you can close that trade and then redeploy the dollars there to create a new trade, and then place that. Okay. The ease of use between Tasty Trade and Toss, they have different different ways of trading. They're all pretty good. Actually, those two are actually pretty good. Okay. All right. Okay, so let's go through the process for a monthly trade. All right. So the monthly trade is very similar to the 7DTE trade. It's just a little bit slower. Okay. So I'm going to take you through several trades for the monthly trade. Again, widening the spreads gives you additional further away from the market, but it's more risk. Okay, so again, close the trade at 10 cents. That's how we close it, or expiration. I don't like to, especially with monthly trades, it may take a long time to close that trade to expiration, and so you may be losing opportunity for additional trades. Okay, all right. So here again, we roll a trade. Usually I'll use a little bit higher than 5 to 10 on these. I'll use about 40, to 50 points away from the market, just to get a good roll there. Okay. With the bear spread, you can use 2x or 3x credit. You can roll those trades as well. Okay. But again, they're just harder to manage. All right, so this is a scenario here a long time ago, but it works today. Okay, so you can see here a normal you know, a normal delta, right, for these positions on you know, on these, you can see the market is always further away on the put side than it is on the call side. That's just how it works. So this trade was threatened, all right? So you can see here now that the premium went from 35 to 5, and this one went from 35 to 90, okay? So you need to roll this trade at this point, okay? So how do you adjust these types of positions? And you can adjust them with 70 TE as well, okay? And how we did that. Right, so at this point here, we closed the trade that was 5 cents. Okay, that was not threatened. Okay, that was profitable. And then we, you know, once you're able to close that, then there's no additional margin that you need to use. Right, if you roll the trades twice, you'll use additional margin, you know, to do that. But so it's easy to close it, and then roll that trade, you know, where the threatened trade is. And so in this case here, we had a 90-cent debit, and then we put on a 90-cent credit. All right, so basically it was a wash. So it's a debit of 0, and then what we did, we sold the January position, and we collected 50 cents. So all in all, basically we got a credit of 45 cents with this trade, and basically that's how we close it. So the premium collected overall on this trade was $1.15. You know, by allowing yourself to roll that trade, it'll still be profitable over time. Okay, and so this is how it ended up in the end on this trade, and the market cap, you know, stopped going down, and we were able to close that trade. All right, so here is a quick example of how these trades work, the monthly trades. So the distance on these you know, on these monthly trades are pretty large. Okay, and so it's kind of like a, you know, a great trade for someone that has a career. Okay, because you don't have to take a lot of time to manage these. All right. So here we put on a put spread for 85 cents and a put spread and closed that put spread for 55 cents. Okay, so collected, and these are 10 contracts or 5 contracts that we're using, and so we collected $150, you know, just by closing that trade. Okay, so now we put on a call spread 55 cents and a put spread for 70. We closed that trade for 10 cents. And now we collected another 300. In this case here, we put on a call spread, and then put on a put spread for 65, and then closed the call spread for 10 cents, which gave us another 225, and then closed the call spread for 35, gave us $150. Then we put on a call spread for 55. And close that call spread for 15, so that's another 200, and it gave us 1,025. Okay, from January through February, basically, for these trades. Okay, and so I've actually gone through a whole year of these trades, and it's just a phenomenal trade. The monthly trade is a really easy, non-stress way to trade these. Okay. All right. So let's go through the ES options on futures. Okay. Let me clear that. Yeah, this was for another one. So let's go through. Okay. Let's talk about SPX and ES. All right. All right. So the difference between ES and SPX. So now we're talking about options on futures. Okay, so ES there's overnight risk for SPX, no overnight risk for ES. The multiplier is 100 and the multiplier is 50, and you'll see why that, why they use that. Okay, in a few minutes here. Greater margin requirement, less margin requirement for ES. Ability to roll into later expirations. That's what you can do in SPX. Rolling is restricted in ES contract. You can roll it within the position, but not outside that. Like you can with SPX. Okay, SPX is cash settled futures contract settled for ES, and depending on where it settles, it could be cash settled as well. Okay, a little different. Commission fees are less expensive on SPX, more expensive on ES. However, you'll see the benefits of ES contracts, options on futures. All right, so here we're using 38.40, 38.30 for 80 cents. Okay, one contract. So you can see here that the margin requirement is 921. And here it's 506. Okay, so remember the 110, you have to divide that by 2, so you're actually getting 55-cent credit on this instead of 80, right? So you have a 52% additional premium for the credit on the SPX side, and 82% additional buying power required. Okay, so you can see here it's $921 and $506. Okay, but you're only getting half of the credit, or a little less than 55 cents instead of 80. Okay, all right, so that's how that works. So now let's look at it with a 15 wide spread. So instead of a 38.40, 38.30, we're looking at a 38.60, 38.75. Now keep in mind, now we get a credit, right, of 160. So divide that by 2, you get 80, right? So now we're looking at apples and apples, okay, or whatever. So now you know that these really are they're coinciding now. So you're looking at now $921 for that buying power, and this one $762, right? Basically with the same credit. So your buying power effect is much greater than you did with SPX, because you're getting the same credit, basically initially the same credit, but you're getting 21% additional buying power for using this. And so yes, ES futures are more expensive. However, the buying power really matches up to that, and allows you to trade bigger. Okay, because you have less margin or more buying power than you do on the SPX. Okay. All right. And these are great for 1 DTE, and that's what I use them for, basically, because there's no overnight risk. Okay, so what happens here? So we enter these spreads within first hour of the overnight session, or I like to do it at around 2 o'clock. 2 o'clock in the afternoon. And the reason I like to do it at 2 o'clock in the afternoon is because what happens is that around 2 o'clock or a little bit after, okay, the market is going to close at 4 o'clock. Okay, so the market begins to price that in when you're putting on these positions. So once the market prices that in, it's pricing it in because the market's going to close, and after 4 o'clock, between 4 o'clock and 5 o'clock, seldom the market is moving. Okay, it's just very, very slow, and then the market closes at 5 o'clock, and then it reopens at 6 o'clock. So you're losing all that time of those positions, and they decay. They decay faster than they do during the day. All right, and that's why I like to do that. I like to put those trades on at 2 o'clock. Okay, so I like to take these profits, and re-enter the trades, as well. And we'll go through that here. Okay, so I like to put on the premium around $1.15 to $1.40. It gives you a delta of 6 to 8. And then take profit is 10 cents or 5 cents. I usually take 10 cents, just like everything else. Or you can go to expiration. Okay, trade is threatened. You want to short. You want to get out of those trades. You don't want to mess with those. Just take the stop loss on those on the call side and on the put side. All right, it's just too difficult to manage those with trying to roll them within the same expiration. Okay, so rolling a trade using a condor, 20 points of breach, possible, yeah. So you close the threatened trade and open a new trade with a net credit. So this is something that you could do, but again, I just use the 2x, 3x, and it works well. All right, so let's go through these trades. This was a while back, okay, and show you how this works. Okay, so I put on in this case I had two contracts. Again, these are 15 wide, and I put on 60 cents, and this one was 70 cents. So this is a very bad trade. So you're putting on the call when the market's going up, and you're putting on a put when the market's going up. So the put is higher than the call, and it's just very unbalanced. It's just wrong. And so what I did was I closed that trade. It was going in the wrong direction. Took my loss, and then I took a loss on the other side because the market went down on that put. Okay, bad trade. All right, so after that, put on a put spread, right? And you can see here that it's pretty much the bottom of the market. So we put that on for $1.30, and we closed that trade at 10 cents. Put on another trade, a put spread here. For $1.10, and waited here for the market to actually go down, and that was a steep move down, and then it went up close to the market to close, and we closed it for 5 cents. Sold a put for $1.20 and bought it back for 60, and that made a profit as well. Okay, so you can use these. And there's no PDT restrictions on these. And these trade just like very similar to SPX. So if you want to get away from the PDT rule, you can actually use these trades instead of SPX. Okay, it's just another way to do it. Okay, here sold 38.15, 3800, 120, closed it at 10 cents. Sold another put for $1, waited, market went down, went up, but as you're getting closer to the end of the market, the decay is very, very fast. Okay, and so these are great trades to basically use to in a market that's going to close very, very quickly. Okay, but it could also go against you as well. Okay, so made it 82.50 on that trade. Here we go through the put side. Here we put on $1.30. We sold a call side here for $1.05. Closed the call for 35. Closed the put for 10. And then we put on another put spread here, close to the market here. Market went up, and we closed that put. Yeah, we closed that put. I think it was 10 cents. Okay. All right. So that's how ES futures or options on futures work. It's just a great tool to use, especially on 1DTEs. All right. So let's talk about micro futures now. Okay, we're getting close here. So let's move on here. So micro futures is a uh, is a it's a directional trade, and it's not like SPX. So the margin contracts for these micros are 1200 and 1760. You can use these basically for if you trade like Tradebait. It's a great broker. They'll allow you to trade day trades using $100 for one contract. Okay. Once the session closes, then you're going to get full margin requirement for overnight. But for day trades, they're great. Okay, trade setup. You want to do longer term MES, MNQ. I like swing trades. For these, a lot of traders use scalp on these, but I like to use these trades because I can add positions because they're pretty small positions and manage them that way. Okay. But I'll share some patterns that will work really well. So these are great for ABCD patterns, and if you don't know about those, read up on those. It's a great way to trade micro futures. Okay, I use fibs on these. So in this case here, this is a retracement position. Looking at it right now as a retrace and then looking to get in around that area, okay, at the bottom. And so I like to use, for one contract, it's advisable, that it's less than 10K. So, I just want to have that cushion. You don't need, 10K to do that. But if you're using multiple micros, then you may need to use those. Okay. All right. So you can see here that the C leg is identified, and that's where you want to get in at the 23.6 level or above. It's perfect between 23.6 and 38.2. So that's where you get in. Okay. So again, here's your retracement. And you want to get into this position around this area here. Okay, that way your stop is very low. If you have to get out and you don't lose a lot of money here. Okay. All right. So the target is established by using the fib extension. Okay. So we're using the retracement. Now we're using the fib extension. All right. So AB is equal to CD, okay, and that's where you take your profit. So you take your profit, or you get into this position here, and if it goes down, then you get out, at the A level. Sometimes, there's an ABC pattern that's higher, and I'll give you that example in a little bit. Okay, another way to do it, another way to trade these is using IB initial balance, and it's basically between 9:30 and 10:30 when the market opens, and you select your high and low at from those times. And so you can see here that it was 10 o'clock already, and the market and here was the low, right? So you go to 10:30, and that's where your high and low is, right here already. Okay. And so you can see here that the position moved up into those areas, but then it broke out, false breakout, and moved down. Okay, and this is the 5 minute. So you can see here what happened over time. Again, went up. It was a false breakout, and then it was a great short right around this area here. Again, if you're shorting here, you want to put your stop at the top, and then if it's going to go up, then you're out. And in this case here, the market went down right to the low level of the IB level, and that's where you'd want to get out and take your profit. And you can see how fast that went right back up. Okay, so finding a bottom. A bottom is formed after it tests or fails. Okay, and so in this case here, the bottom went up, it went down, it failed. It's not a good trade. That's not the right setup. The bottom test and failed again. Here we got another bottom. Market went down again. Test failed. Excuse me. And so here finally went up, and then it didn't go back down to this level and break. And so that's where you'd want to get in. Okay. So that's your reversal there. All right. So here's the reversal again. And I'm showing you here divergence. So divergence means that the market is going down when RSI is going up. So this is RSI, and it's just a great tool to use to ensure that you're going to make money on that. Okay, so let's look at highs and lows. This is where you want to get in again. You see it goes higher, higher, and higher. So you have higher lows and then higher highs. And then once you get to this level here, this is where you want to get out because the market's going down. So you're lower high, and that's where you short or you get out of that trade. Okay, so here's another example of an ABC trade. A, B, C, D. Okay, so you wait until that market goes down, and then once you get a signal down, that's where you close. You take that trade and you go down to the D level, and that's where you get out. Okay, so here's another example of an ABC, and you can see the A, B, C, but it's much higher here, right? So it's a little more dangerous. So you want to have a stop under here, not necessarily in the A area, all right? So you have an A, B, C, and then your extension goes to 100 or 125, right? And that's where you get in here, take a small stop here, and then allow this to move higher. Okay, and that's your D, and that's where you get out. And a lot of times the market may just continue to go. All right, so that covers the all the 5 different areas that I use for these trades. I'm a little over here. So the question is, again, if you're interested in learning new strategies, desire to see your account grow, find the right strategies that provides consistent results, this is it, okay? This is it, guys, right? So if you want to break these barriers, that you've been struggling with, right? The problem is that are you going to keep doing what you're doing and think that it's just going to stick, or are you going to make the final steps here that really allows you to trade and trade well? Okay, you need to have a no quit attitude, commitment, discipline, and having an edge. All right, that's success. All right, so the question is, would you like to follow our trades while you learn at the same time? Especially with these short-term strategies. And of course, the answer is yes. You're going to learn as you earn, all right? So we have a Telegram service. It's tied to my account, except for the futures account. And we basically, we're trading all of these trades. In addition to that, we have a couple of other traders that we use, that we have. And they're making those trades as well. A lot of very good trades. And these guys trade for a living, guys. Okay, this is what we do. So we have a Telegram service. We have 2-way communication, and then we have 1-way communication. And this is where our alerts go, to the 1-way communication. So it's very, very clear and concise on where you take these trades. All right. So a lot of success stories here, and honestly, people come here, they stay 3-4 months, and a lot of them move on because they've learned what we do. Okay, and we don't we're not sharing, we're not sharing our secrets. I mean, we are sharing our secrets. Okay, so there's nothing to hide here. Okay, so these are great success stories. However, I give you a guarantee. So if you guys come in and you lose, you lose money in the first month, I will give you the subscription amount back and plus 25%. So, and actually I've been in this thing for 5 years and I've never had to pay someone back. And the reason is because, we do a lot of trades and we really are diversified in the, so some trades come out good, and some don't, right? But overall, we make money every month after month, okay? So here's the offer. For $39, $79, and $109, you'll get 20% or $20 off for life. Okay, right now we're open to the we're open to new subscribers, but in a week we're going to be closed to new subscribers. And the reason for that is because we like to, we do the marketing, we bring in people, they answer all the questions, and then after a couple of weeks they know what to do, and so we close the service and we focus on the traders. Okay, and that's what we do. So here's our offer. If you want to join us, that's great. You get the $20 off. We're now open now, but in about a week we're going to be closing again and moving on, and then you won't be able to go back in until 3 months from now. Okay, and that's how we do it. That's how we work. It's a great way to learn what you want to do, and it's really a great system that allows you to learn all of these trades and more actually. And most people, again, they stick with us. So about 20% stay with us. The rest, go on to learn different things. Okay. But it's just a great tool to be able to learn this thing. Okay, so if you want to learn a step-by-step process and gain income in a market that goes up and down, and you want to finally break these account drains, and you want to be consistent, this is it. I mean, it's just a great place, a great community that we have here. All right, you get $20 off for your subscribing, and you can join today. Professional group of traders, and these are traders that trade for a living, and we have training and education channels in there. We have automated signals within not many seconds, a little bit more than seconds of the trade. We give you the trade entry fill price and the price target after fill, and we basically help you with adjustments too on these trades. Okay, my guarantee to you, you'll make money. Okay, and it's a winning strategy. So we also have a free newsletters, and I share my trades in the next day, right? Every Monday and Wednesday and Friday, so you can actually see what we're doing over time as well. All right. So hopefully this was of this was of value to you. Let me see if we have any questions. I think we're good. If you have any questions, you can send me an email. And again, it's just a great way to to make money, and it's a great community. So hopefully I'll see you there. And even if you're not there, I hope this was of value to you, and I thank you, and we'll talk to you soon. All right. Thanks, guys. Have a good night.